Welcome to my own FP. Today we're going to take a look at setting up large expenses and or depreciating assets, specifically things like cars that you can set up in a couple different ways. So we're going to take a look at setting them up as a large repeating expense. And the other way is we're going to set them up as a property. There's pros and cons to each way. As an expense, basically you just use whatever income or money that you have coming in at that given year, and you have your rules depending on how you want to pay for that. But there's no way to sell that asset or vehicle at that point, any point in time. If you want to set it up as a property, it's also interesting because you can depreciate that. You can sell that asset. It still shows up in your net worth and estate. You can have associated purchase costs and sell costs. You can have ongoing expenses during the lifetime of that asset. And in either case, you can set up a set of source accounts, liabilities, cash, TFSA, and whatnot. There's slightly different tax consequences right now for how you have set them up, so you should take a look at how that is done. So let's take a quick look at how to set up an expense, a car expense over time. So let's look in the software. And so we have our client Aston and his partner Martin. And we're going to set up a variety of expenses here. So the first ones, we're just going to do these over every 2 years. So starting in 2030, we're going to purchase a Vantage. So let's take a quick look at how we're doing here. So it's going to cost $50,000. We're splitting that with our spouse. We're going to repeat that every 16 years up to age 90. And we're not setting a source account for this. So whatever rules or income that we have, we're just going to use that to purchase this car. Okay. The Vanquish, we're going to set it up the next 2 years later. Same set of parameters, except for we're setting up source accounts for it. So you can set up these in whatever order you want, any value you want. It'll be limited to the value of the total expense. So you can, if you don't know how much money you'll have in your cash or TFSA at any given time, you can just set the total amount, and it'll take as much as possible from each one of those and then go to the next one in order. So that's how source accounts work. The Valiant, we set this one up as a non-repeating expense, so we set it up every 16 years in 2034 and 2050. Same value. We're splitting that with our spouse. And in this case, we set it up as a line of credit. And we'll look at our line of credit a little bit later. And so we're just going to take all $50,000 out of our line of credit to purchase the car. If the value here you say is $40,000, we'd take $40,000 out of our line of credit, and the extra $10,000 would be based on our current income, whatever rules you have to try to get that income from somewhere else. So you can do that as well. Okay. If we set them up as a property, we have two of them that we're going to do here. So we're going to set up a DB12. We're going to purchase this in 2036. We're going to purchase it for $60,000. We have 50% of that cost is going to go to with our spouse. We're going to take it either from cash or the TFSA. We're going to deflate that by 20%, so negative 20% inflation. And if we don't have enough in our cash or TFSA, it's going to come out of our line of credit or car property account for a liability. In 2051, we're going to sell 100% of that car. 2053, we're also then going to repurchase it. The same values, but we didn't set a source account. So in this case, we're going to take it all from our line of credit car prop liability for this account. Okay. And yeah, so cancel that. The DBX, what we've done here is a little bit different. We've said we're going to purchase it in 2042. Actually, there is no source account, so our source account is still 0 at this point in time. We're going to sell it in 2045, 3 years later. Now, the difference is we have purchase costs of $6,000, so that's going to be added to our purchase value of $60,000. The asset will still be $60,000, but we're going to take $66,000 from our line of credit. We are then going to use expenses during the lifetime of that asset. So for the next couple of years, we're going to have $5,000 going to our expenses, and which can be useful for things like insurance or gas or whatever, maintenance or whatever it has to do for a car. If we sell the car, then those go away. Just like if it was a property and you had your insurance or maintenance on a house or a cottage, if you sell that cottage, then those go away. You don't have to readjust your general expenses. So it's kind of a new field that we've added to make things a little bit easier if you want to sell certain properties. And we have selling costs. So we have purchase costs, we have expenses during the lifetime, and we have selling costs as well. So the selling costs will be removed from the amount of value that we got for the sale of the property. Okay. And let's take a look at our liabilities. So we have one for expenses. We just separate them out. This one is no loan value. We're going to set the interest rate at 6%. We're setting it at interest plus. So however much interest there is for that given year, plus $8,000. So that's one way to do that. And this one's set up exactly the same way, just a slightly different interest rate, no value. And so let's take a look at how this runs. Let's take a run here. Okay. Let's take a look at joint 2025. And so you can see that at the Vantage in 2030 and one in 24/6, Vanquish. So those are how the cars are expensed if we're going to use it as expense. You can see it's a little bit tricky here without going into too much detail. The first one is just done through our normal income. So we went from $130,000 to $180,000 in gross. The second one, we did go up in gross, but we've taken that specifically from our cash and non-registered accounts. So if we go in here, we can see that specifically in this year, we took some money out of our cash and of our non-registered accounts. So we took a lot more money out of non-registered and a lot more out of our cash. To do that, we'll take a look at our gross later on to see where that came from. This one here, we took this out of our line of credit car expense. So, and that we start paying that off over time. So and then we do that 16 years later. And okay, so that's how those work. If we do this as the DB12 case, we set this up for $60,000. And we were going to take this from our cash and TFSA, I believe, in this case. So those went down a little bit. If we take a look at those, we can see here that we took a $60,000 withdrawal out of our TFSA in this particular year. So it all came out of TFSA first, it looks like, because we had no cash in that year. So everything came out of our TFSA. And then we depreciate that by 20% every year. So that just keeps going down until we sell the vehicle in 2051, which we asked for. And then we repurchase it again in 2053. In this DB12 case here, the first time we set it up this way, the second time we set it up as using the line of credit. So the $60,000 came out there. We start paying off our line of credit for the car property. And we depreciate the asset over time. Okay. In the DBX case, it was $60,000. We added $6,000 that as a purchase cost. So our line of credit for our property is charged for $66,000. We start paying that off. We sell the car in 2045, and the value of the DBX at that point in time would be we would sell the car. We would pay off our line of credit. We don't have enough because our line of credit is actually more than the car values, and then that would also have to come out of our gross for that given year. So that'll actually, in this 2045, you can see here this $158,000 is some extra money that we had to use to pay off that line of credit. You can also see the expenses here. For the property, we were $5,000 every year after we purchased it. So we purchased it at the end of the year in 2042. Expenses come in the next year for 3 years. They come in including the year that we sell it, because purchases and sales are all done at the end of the year. So all that is done in there. The other thing we can take a look at quickly is our gross. See where all the money came from. Let's look at this in joint in $2025. A little bit of rounding issues going on in here. It's basically $50,000 though. So in this case, we took $50,000 from our line of credit in 2034. 2032, we took some from our line of credit, or some from our return of capital from cash. We took from some as a capital gain from our non-registered, and we took some from our return of capital and non-registered. So we sold a bit of our non-registered account. Some of that becomes return of capital, some of it comes a capital gain, and then that ends up being the amount that we need for the car in that year. The previous year, 2030, we didn't have a specific car thing that we did. We just pushed it right into our set of expenses. So this just becomes a general add income rule, additional income. So we use some additional income from our RSP. We use some additional return of capital from our cash account as well. That's just the way the rules worked. I think right now it's a 10% limit of our RSP, so that's the max we could take out of our RSP at this point in time for that year. The next things we want to take a look at: when we sell the car, we get this amount of money back for the DBX case. When we sell the car, we get this much back from the DB12 case. So those are sort of standard. And the rest of it is, that's pretty much it. So the difference is when we use property, these are all done as expenses. You'll see there's no line of car property here. When it's done as a property, we don't take the sale into our gross. We just take it straight from the account and use it. Properties assume that you have done some bookkeeping and accounting so that you won't end up with a big tax consequence at the point in time when you're trying to purchase a car or property or whatever that might be. Whether that's true or not is here or there, but we just make that assumption right now in the software. So there, that's how we look at our gross, and we can see all the different components that went into that or came out of it. And then obviously those are the expenses that we had. You don't see those expenses when it's a property. They just get straight taken out, because they don't get into gross, they don't become expenses. So when it's a property, it just becomes straight from whatever account it is, straight into the new asset that you're purchasing in the property. So those are the different ways you can purchase cars or other large expenses. Repeating expenses are useful, and you can do that if you want a new roof every 20 years or whatever it might be. You're probably not going to depreciate that as an asset necessarily. Cars are kind of useful because you could buy and sell them every few years, or maybe you had something else that you wanted to depreciate or appreciate. It doesn't have to depreciate, it could appreciate as well. So anyway, that's how you do large expenses and or depreciating property. Thanks very much for watching.